Good afternoon and welcome to the continuation of our series of virtual roadshows on our new relationship with the EU. Our last session looked at trading with Northern Ireland and the implications for business. Today we're drilling down into VAT and how it works in the new relationship. Firstly, we'll hear from HMRC colleagues who will look at export and dispatches, import and acquisitions, postponed VAT accounting and Northern Ireland. Then Mark Ellis from BDO will explain the complexities of how to register and pay VAT in EU member states. There'll be a short Q&A after each of the presentations, and we'll be sharing a few short polling questions at the start of HMRC's Q&A, which we hope you'll take time to answer. However, before we begin, just some very quick housekeeping items that we need to note. All attendees are in listening mode only, and only the panelists' videos are visible. If you want to engage with the panelists or ask a question, you can do so by typing your question into the Q&A box in the Zoom control bar at the bottom of your screen. Aaron and I will be moderating any questions during the Q&A session, which will follow our presentations today. We're not using the chat function with so many of you on the call, so please use the Q&A facility instead. Finally, today's webinar is being recorded and will be available on Make UK's website afterwards, and we'll share slides with participants after the event in our follow-up pack. So with no further ado, please let me hand over to HMRC's David Pruden. Thank you, David.
Thank you very much. My name is David Pruden. I've been working on the introduction of PVA, Postponed VAT Accounting, for getting on for 2.5 years now. So ever since it was first agreed as something to be looked at from a day one no deal perspective back in 2018, I've been working on that. So if I can move forward. So the content slide, which I think has just has been mentioned in the introduction, so I think just move across to the next slide, which is the exports and dispatches. So just one thing to say, I'm generally going to be talking, and I think probably with all of us on the VAT side, we'll be talking mainly from the perspective of VAT registered traders, but we will have some references to non-VAT registered traders as we go through. So just a brief sort of comment with regard to dispatches and export, some of the basics. So movements of goods from Great Britain to the EU are now exports from the beginning of this year, but movements of goods from Northern Ireland to the EU continue to be dispatches under EU single market rules. So this means for goods moving from Northern Ireland to the EU, the previous intra-community rules will remain, and suppliers business to business, that's VAT registered business to VAT registered business supplies, will be zero rated as dispatches. The next bullet is a specific excise point, so I won't go into that unless anyone has any questions later. But the last point is that for exports from GB to the EU, goods are zero rated, and that's whether or not they are excise goods. So next slide, please. So with imports and acquisition, so this is in some ways the opposite of what I just said, the first part. So movements of goods from the EU to GB are imports. So if you're VAT registered, no longer acquisitions. That means import VAT, not acquisition VAT, will now be due. But acquisition VAT continues to be due on goods moved from the EU to Northern Ireland. Postponed VAT accounting, which will be a large part of what I'll be talking about. This is available to UK VAT registered traders, and that's if you import goods into Great Britain from anywhere outside the UK, or if you import goods into Northern Ireland from outside the UK and the EU. And postponed VAT accounting, it allows importers, VAT registered importers, to account for and recover import VAT on the same VAT return. Other existing means of paying import VAT are also available. So if you're familiar with those from the rest of the world to UK imports, they are still there. And this is what non-VAT registered traders will be doing. That's how they will be paying the import VAT when they make their customs declaration. So on a duty deferment account quite often, or it can be made upfront outright at the point of the customs declaration. Different rules for consignments of 135 or less other than excise. We'll be covering that later on when I hand over to Will. So the next slide, please. So postponed VAT accounting, that is selected on the customs declaration. And if you're using Chief, which virtually everybody will be, it will be the trader's EORI that needs to be entered to select PVA. If you're using CDS, you enter the VAT registration number in the appropriate place on the customs declaration. So an online monthly statement is generated, and the trader will be able to access and download that. And this is what contains the information the trader needs to complete their VAT return. I'll be saying a little bit more about that later. You don't need to be authorised to use postponed VAT accounting, but you do need to subscribe to CDS purely for the purposes of accessing the online monthly postponed import VAT statement. Again, saying a bit more about that later on. To use PVA, the imported goods must be for use in the trader's business. I've got a slide later on where it's part business, part non-business. Non-established taxable persons. So first of all, a number of specific categories. If you're a non-established taxable person, you are entitled to use PVA, but the general provision applies for non-established taxable persons, applies here as well. In order to import goods into the UK, a non-established taxable person does need to hold a UK EORI, and they do need to instruct an agent to make the customs declaration on their behalf. So if they're using postponed VAT accounting, they also need to tell their agent that they wish to use postponed VAT accounting. On the next slide, please. So another particular category of case, so postponed VAT accounting can be used when imported goods are removed into free circulation from a customs special procedure. So typically a customs warehouse, if you move the goods into a customs warehouse, when you remove them from the warehouse, you can select postponed VAT accounting then. And for excise, postponed VAT accounting can also be used when you import excise goods, and this is excise goods of any value. And that's at the point they are released for home consumption. So this includes when goods are released from an excise warehouse, having been in duty suspense since the point of import. So postponed VAT accounting, its use is normally optional, but there is a particular category of case where its use is mandatory. And that is if you're using the customs facilitation of staged customs controls. So if you're importing non-controlled goods, standard goods, into Great Britain from the EU between the beginning of this year and the 30th of June, then you do have to use postponed VAT accounting, which means you do have to account for the import VAT on the VAT return. And that is if you use the entry and declarants records process. And that will apply whether or not you delay the customs declaration. So if you make an entry in declarants records, whether or not you in fact delay the customs declaration, then you do have to use postponed VAT accounting. A bit more on how to actually do that on your VAT return in a later slide. So next slide, please. So if you're using someone to import goods on your behalf, so any sort of intermediary, freight forwarder, customs agent, broker, fast parcel operator, then you do need to tell them that you want to use postponed VAT accounting, and that means they will then complete the customs declaration for you in the way that you want to use it. So we are aware that some people who are wanting to use postponed VAT accounting haven't actually told their agent that they wish to do so, and until they, until such time as they do, the declaration in some cases is not being made in the way that the trader wants it. So the important thing, clear communication. The second bullet, again, you may already have someone that you may have an agent, and certainly if you're importing goods already from the rest of the world. And again, tell them if you want to change to use postponed VAT accounting from the 1st of January or from now on if you haven't done. But make sure you keep a written record of what's agreed. And the next slide, I sort of say a bit more about business, non-business. Essentially, we allow the use of postponed VAT accounting where it is at all possible for us to do so. So you're able to use postponed VAT accounting to account for VAT on your VAT return if you import goods which are used for both business and non-business purposes, or if you don't know whether or not they will be used for business purposes at the time you import them, and in such cases you make an appropriate adjustment to the amount of import VAT you then claim back as import tax. But you can't use PVA, you can't put VAT on your VAT return if you import goods and you know at the point that you import them they will be used solely for non-business purposes. So in those circumstances you do have to complete your customs declaration and select one of the other methods of payment, so immediate payment or duty deferment account. Next slide, please. So completing the VAT return. Essentially, there's one key change to the way you complete the VAT return, which is the top one, box 1 on the VAT return. You now include the import VAT. So the VAT due on the import through PVA goes in box 1 of your VAT return. You then claim that back in box 4 of your VAT return, and box 7 as now includes the value of imports in it. So then, I say as now for existing rest of the world to UK imports, as was always the case pre-January. So the normal VAT rules about what can be reclaimed as import tax apply as for any other purchase. And the Trader's Monthly Statement does contain the information you need for that. And you do need to download the declaration. It will only be accessible for 6 months directly once made available. So you do need to make sure that it's downloaded and you don't just leave it accessible on your from the screen that you can access. It won't always be there to access. You've got 6 months to download it. There are particular issues. It's more tricky if you're going to delay your supplementary declaration to complete your VAT return, because you won't actually have your statement available, because you won't have made the customs declaration at the point that you complete your VAT return. So at that point, you'll need to estimate the import VAT due from your other records. So from your entry declarant records or other business records, you'll have to make an estimate of the import VAT. And when you do then submit your delayed declaration, which can be up to 6 months later, you have to select you're using PVA. You will already be doing so. And that will generate the online statement. And then that will then show the accurate figure of import VAT due, and then you can compare that with the estimate that you previously made and account for any difference on your next VAT return. Now, if you're fully taxable, the import VAT that you declare and what you're able to reclaim will normally be an in-out transaction. So it's just a case of making sure that the figures are correct. But in most cases, if you are fully taxable, the net tax is actually nil. And next slide, please. So accessing the PVA statement. So you do need, as I said, you do need to access CDS to view and download the monthly postponed VAT accounting statement. Now that, if you're using Chief, as everyone is, the only reason you're accessing CDS is to get access to the statement itself. You're not using CDS for any wider purpose than that. And importers that already have access to CDS, and that that may be some people, but if you're importing into Northern Ireland, you'll go straight to the start page, to the CDS financial dashboard, where you can view and download the statements. But businesses without existing access to CDS, which will be most cases, they will be automatically directed to sign up to CDS first. Signing up for CDS, straightforward and takes only a few minutes. I would say we do know that practically there have been difficulties that certain traders have had. So it should be straightforward and take only a few minutes, but we have been told that there are cases where it has proven to be far from straightforward. Anyone who's got any questions about that, I think we'll probably take in the Q&A session. The first monthly postponed VAT accounting statements, they became available on the 10th of February, and they show the import VAT postponed in January. Each member of a VAT group that imports goods. So a specific issue with VAT groups, which means it's a bit difficult than it would have been previously with accessing C79 statements, hard copy C79s, so each member of a VAT group that imports goods will have their own EORI and should sign up for CDS to access their statement. And then the representative group member will have to collate the statements to complete the VAT return. That's simply the way that CDS works. We recognise that this is much more complicated than it would have been, particularly if there were a large number of members in the VAT group. Previously, with hard copy C79s, the representative member simply got a single record. Now, each individual member of the group will have to access their own statements and pass them on to the representative member to complete the VAT return. Okay, I think that's probably me done for postponed VAT accounting. So I can hand you over to Will Pereira now to cover consignments valued at 135 or less. Thank you.
Thanks, David, and hello everyone. My name is Will Pereira, and I also work in VAT policy at HMRC, and I'll be talking through the next couple of slides on low-value imports. So the UK has introduced a new model for the VAT treatment of overseas goods to improve both the efficiency and compliance of businesses accounting for VAT. The new model applies to goods imported into Great Britain from overseas and goods imported into Northern Ireland from outside the EU. So one of the main changes here is that VAT collection on consignments of goods valued at £135 or less has shifted away from the border, and businesses liable for VAT now have to register and account for it on their VAT return. So picking up from the first bullet, for goods located outside the UK at the point of sale and sold to customers in the UK, specifically in Great Britain, those customers will have UK VAT charged at the point of sale. For goods located outside the UK and EU at the point of sale and sold to customers in Northern Ireland, those customers will have import VAT charged. Another key change we have introduced places greater responsibility on online marketplaces in VAT collection. So where an online marketplace is involved in facilitating the sale, it will be responsible for charging, collecting, and accounting for the VAT instead of the seller. For goods sold by direct sellers, so without any marketplace involvement, the seller will be required to register and account for the VAT. The £135 limit applies to the total value of the entire consignment, so not the separate value of individual items within a consignment. And another key change is that low-value consignment relief, also known as LVCR, which is the import VAT relief for consignments valued at £15 or less, has been removed. So VAT will now be due on all goods supplied from overseas. Could we have the next slide, please? Thank you. So for business to consumer supplies, or B2C, this is where the customer is not registered for VAT in the UK, or where a VAT registered customer does not provide its VAT registration number. That will also be treated as B2C. So here, the seller or the online marketplace where it facilitates the supply will be liable to register and account for UK VAT on their VAT return. If they are already registered for VAT, they will not need to register again. For business to business supplies, or B2B, this is where a UK VAT registered customer provides its VAT registration number to the seller or online marketplace. So here, the VAT registered business customer is responsible for accounting for any VAT due on their VAT return. So for goods imported into Great Britain, this is done using a reverse charge. And for goods imported into Northern Ireland, this is done using postponed VAT accounting. And businesses will be able to recover the VAT as input tax, subject to the normal recovery rules. The final point to make here is that there are some exceptions to the rules I've covered over the last two slides. So the rules do not apply to consignments containing excise goods or to non-commercial transactions between private individuals, sometimes also described as consumer to consumer or C2C, and this would include gifts. So these goods will be subject to the rules for consignments of goods exceeding £135, with import VAT typically collected at the border. Okay, so I think that's it for this section. Could we have the next slide, please? And I think I'm handing over to my colleague, Phil. Thank you.
Thanks, Will. Good afternoon, everyone. I'm Phil Crowley. I work on VAT under the Northern Ireland Protocol in the policy team. So I'll just talk through a few slides as to how that will work. So kicking off with movements between Great Britain and Northern Ireland. For most transactions, where goods are sold between GB and NI, VAT registered sellers continue to charge customers VAT and account for it on their VAT return. It will now be import VAT, which means that it's subject to import VAT rules, including on valuation. This means that VAT will be calculated on the customs value of the good, which does include expenses such as transport and insurance costs and any customs or excise duties that are due on the import. This means that import VAT will not need to be paid at the point of arrival into Great Britain and Northern Ireland, as it's going to be accounted for via the VAT return in most cases. The customer, if VAT registered, can reclaim import VAT subject to the normal rules, effectively meaning they can claim it, they can reclaim it where it's being used to make a taxable supply. There's a new requirement where the business moves its own goods from Great Britain to Northern Ireland. Import VAT will now be due. Now, the business may reclaim that VAT as input tax, again, subject to the normal rules. So there shouldn't be any tax effect for taxable businesses, as they'll be able to reclaim input VAT in box 4 on the same VAT return that they account for the output tax in box 1. Important to note that an import VAT charge will not arise where a business moves its own goods from Northern Ireland to Great Britain, unless this is part of the sale or supply of the goods. So this requirement will only be in effect for movements from GB to NI. Next slide, please. So some exceptions where the principle of seller liability won't apply. Goods subject to domestic reverse charge rules, where this is for things like sales of gas and electricity to VAT registered businesses. In these cases, the customer will continue to account for the VAT via the VAT return and can continue to reclaim input VAT subject to the normal rules. Another exception will be where goods are declared into a special customs procedure. Where this is used, the customer or importer must account for the VAT when the goods exit the procedure. Also, goods subject to an onward supply procedure. Now, this is available where the goods move from Great Britain to Northern Ireland and are consigned to be moved on to a final destination in an EU member state within a month. Where this is used, the final customer in the EU will be required to account for the VAT as acquisition VAT. Now, the importer in these cases can zero rate the goods, but would need to include this onward supply on their EC sales list. Finally, as has been touched on already, another exception where goods are sold by a non-UK seller through an online marketplace. In this case, the online marketplace is liable to account for the VAT. Next slide, please. So moving on to VAT groups. VAT groups can continue to include members established in Northern Ireland, as well as members established in Great Britain. So there is no requirement to restructure a VAT group which contains members in both of those places. Additionally, broadly speaking, transactions between VAT group members will continue as now, and in most cases can continue to be disregarded for VAT purposes. However, there are a small number of exceptions. One of those being where supplies move between group members and where the goods move from Great Britain to Northern Ireland. Now, these should be accounted for in the same way as a movement of own goods, which, as touched on, in these cases, the business should account for output VAT and input VAT entries on the same VAT return. The other exception is a supply of goods in Northern Ireland between members where at least one member, so either the seller or the purchaser, the acquirer, is not established in Northern Ireland. In these cases, VAT will apply, and the representative member should account for this and can again reclaim the VAT subject to the normal rules. Next slide, please. So movements between GB and NI by individuals and non-VAT registered businesses. Goods moved or sent from Great Britain to Northern Ireland by unregistered businesses or individuals will incur import VAT though in most cases the liability will be reduced to zero. This is because a credit will be applied, which is to be valued at the amount of VAT that has been previously paid on the goods in Great Britain. Now, as it is rare for the value to have increased between buying an item in Great Britain and then sending it to Northern Ireland, in most cases, this credit will cover any import liability that would have been due. However, in cases where goods have not already had VAT charged on purchase, or if the value of the goods has significantly increased since the point of purchase, the credit will not cover the full liability and import VAT will be due. Now, individuals and non-VAT registered businesses carrying goods will need to use the relevant app to pay the import VAT. Individuals and non-VAT registered businesses sending goods will need to use a different solution, which HMRC will introduce later this year. In the meantime, HMRC expects individuals and unregistered businesses to keep records that will enable them to account for the import VAT when this solution is introduced. Next slide, please. Goods moved or sent from Northern Ireland to Great Britain by individuals and non-VAT registered businesses will not incur import VAT unless they have been subject to a VAT res claim. Now, the VAT res scheme will continue to be available in Northern Ireland, and this scheme allows visitors from outside the EU to recover the VAT on purchases they make and then take home in their luggage. So it will technically continue to be available for NI retailers selling to visitors from Great Britain, although the retailer must, in these cases, collect the GB import VAT, which is due on behalf of the customer and account for it on their VAT return. Now, the retailer can only refund the supply VAT to the customer once the relevant form has been returned to them, having been stamped by a customs officer. However, the VAT refund given and the import VAT that the seller will have to account for should be the same amount and should net off to zero. And so for this reason, retailers may decide not to offer VAT res to visitors from Great Britain. So next slide, please. So moving on to movements between EU and NI. This has been covered in some detail already. So where a good is dispatched from an address in Northern Ireland to an address in the EU or vice versa, we look at where the good has physically moved from and to, rather than the business establishment of either the seller or the buyer. So, for example, a business that is established in London, which sends a good from its warehouse in Belfast to a customer in Dublin, would need to account for this as an intra-EU supply. The supply of services is not covered by the NI protocol. However, the rules for place of supply of services are broadly unchanged. Some exceptions are in the slide, as you can see, and further information can be found in guidance on how these are to be treated. Next slide, please. So again, EU and NI, EU to NI movements and vice versa are intra-EU. For business to consumer, distance selling rules apply. Where a business in Northern Ireland is selling to the EU, each EU member state will have its own distance selling threshold, which Northern Ireland businesses will have to take account of when selling to EU customers, because if they exceed that threshold, there will be a requirement for them to register in that member state. As already stated, for B2B transactions, VAT registered customers will account for the VAT as acquisitions. Business to business sales, so businesses that make supplies of goods from NI to the EU will continue to be required to submit an EC sales list. Supplies of services do not need to be reported on an EC sales list, as the services are not covered by the NI protocol. Next slide, please. So there is a new requirement for businesses carrying out transactions with the EU to use the XI prefix when communicating with EU systems or EU businesses, for example, on invoices. So this applies to VAT registered businesses which meet one of those criteria. So if they receive goods in NI from VAT registered EU businesses, if they sell or move goods from Northern Ireland to an EU member state, or if they sell goods that are located in Northern Ireland at the time of sale. HMRC have already identified certain businesses that require this prefix and contacted those businesses before the end of the transition period. However, if you haven't been contacted, businesses can notify HMRC to request the prefix through submitting a G-form on gov.uk. And businesses that have an XIP prefix will continue to appear on EU systems such as Visa on the web. Next slide, please. Thank you. The EU VAT refund system will be available to businesses who are established in Northern Ireland and who make supplies in or from Northern Ireland or intra-community acquisitions. Businesses that meet those conditions will be able to use the electronic EU VAT refund system for VAT incurred in an EU member state for invoices which only cover goods. If a business doesn't meet these conditions, or if the invoice that they're using covers a transaction in services, the EU 13th directive process must be used. Now, under this process, a claim must be sent to the individual authorities in the EU member state where the VAT was incurred. Further information can be found out about this on the EU Commission's website. So next slide, please. So talking now about situations where goods are sold from GB to the EU via Northern Ireland, the VAT treatment will depend on where the goods are when the transfer of the rights to the goods takes place. So if the goods are located in GB at the time of supply, the seller should charge the customer VAT and account for it on its VAT return. In these cases, only the EU customer can recover the VAT using the EU VAT refund system or a UK VAT return if registered for VAT in the UK. If they use a special procedure, such as onward supply, an onward supply procedure or a custom special procedure, the importer must tell the seller when they have used one of these procedures and provide the required references in order to allow the seller to zero rate the export. Next slide, please. So here's a sort of worked example of that journey. So a business sells goods to a customer in Dublin via Belfast. When the goods are sold from the Samir's GB premises, Samir should charge UK VAT to the customer. This will be accounted for via his UK VAT return as output VAT. The goods make the crossing to Northern Ireland and no additional import VAT is payable. The good moves freely from Northern Ireland into the Republic of Ireland, and when the goods arrive at the customer's address in Dublin, the customer can recover the VAT paid using the EU VAT refund system, or if VAT registered, the UK VAT return. Next slide, please. Now, if the goods are moved to Northern Ireland before being supplied, then two separate movements need to be accounted for. The first is a movement of own goods from GB to NI, and as explained previously, this consists of output VAT and input VAT entries on the VAT return. This is then followed by an intra-EU sale. Next slide, please. So another worked example. A London-based business moves goods to Northern Ireland in preparation for selling to customers. The sale is then made when the goods are in Belfast to a customer in Dublin. So the goods begin in Great Britain. They're moved from a depot there to be stored in a depot in Belfast. Now, Charlie must account for this as movement of own goods to Northern Ireland, accounting for import VAT as if it were output VAT, and can reclaim input VAT subject to normal rules. Once the goods are in Charlie's Belfast depot, they are then supplied to a customer in Dublin, which is accounted for as an intra-EU sale. The goods are freely transported from Northern Ireland to the Republic of Ireland, and the VAT can be reclaimed via the customer's VAT return if VAT registered. Next slide, please. So the reverse journey, where goods are sold from an EU member state to Great Britain and go via Northern Ireland. The EU business should charge the customer UK VAT and will have to register and account for the VAT on a UK VAT return. The UK customer can reclaim the VAT as input tax, again, subject to the normal rules. Next slide, please. So another worked example. So a business based in Dublin sells to a customer in London and the goods are moved via Northern Ireland. Now, as Abdul is supplying to a customer in Great Britain, he will need to be VAT registered in the UK and he should collect UK import VAT at the point of sale and account for it via the UK VAT return. The goods are freely transported to Northern Ireland and cross to Great Britain. When they arrive in Great Britain, there is no additional import VAT payable as part of the customs process. The goods will then be driven to the customer's address in Great Britain, and the customer is able to recover this as input VAT via their UK VAT return, subject to normal rules. So that concludes the presentation on VAT under the Northern Ireland Protocol. I'll hand back to Hilary to field any questions from our stakeholders. Thank you.
Lovely, thanks ever so much. Before we start, my colleague Aaron is just going to pop a few polling questions up, and we'd be really grateful if people attending would just take a few moments to answer these. They're very useful for our engagement with HMRC and really help make your views known. So if you wouldn't mind doing that just for a couple of minutes, then we can move on to the Q&A. That would be really marvellous. Thank you. To the UK, they hold their stock in their warehouse and they want to know if there's still import duty to pay when shipping from the UK to Republic of Ireland or any country in the EU, as goods being exported will not be of a UK or EU origin. However, the UK does have a preferential duty rate with India. Would this preferential duty rate be carried through to the export from the UK into the Republic of Ireland and into the EU, please?
Hi, good morning there. Good afternoon even. My name is Mushkan Ahmed, and in reference to that question, so yes, there is still import duty to be paid when shipping from the UK to the Republic of Ireland or any other country in the European Union, unless, however, you enter the goods into a special customs procedure at the point of import into the UK. So, for example, once the goods are shipped into the UK, at that point of shipment, you enter the goods into a transit movement, then you would not be paying import duty at UK and then again import duty in the country or EU member state that you are sort of, selling the goods into. It's also worth noting that you cannot carry over the preferential duty from the UK into the EU member states. You will have to refer to the EU schedules and see what the rate for that, what the tariff code and what the rate is for that good in the EU. So you cannot carry over a preferential rate which the UK applies into another EU member state. I hope that's clear. Thank you.
Thank you for that.
Next question. How can we go about claiming duty back on goods that are imported and duty paid and then are re-exported, which at present means double duty?
David Puden here. I'll take that one, but that is essentially a customs question, and you would follow the customs rules for dealing with that, and any import VAT consequences would follow on the back of the correct customs treatment being applied.
Thanks for that. Here's another one. The hauliers carrying our steel imports and submitting declarations on our behalf have told us they've been advised by HMRC that all imports are automatically treated as PVA, irrespective of any circumstances. Is this right?
No, it's not correct. There's no statement that postponed VAT accounting has to be used in all cases, in all circumstances. It may be that is the haulier's favoured way of treating them, but that is still something that they will need to cite all their customers on. That if those are the terms that they are engaging with their customers on, then that needs to be clear to the customers, and the customers don't have to follow them. They don't have to use postponed VAT accounting, or don't have to use that haulier for that circumstance. So I think maybe they I don't know. I'm not familiar with this, but maybe it's just the hauliers are favour using PVA because it makes life simpler, and because they expect the large majority of people using their services who are VAT registered to want to use PVA, that the message coming across is that you have to do so. That isn't right, and it needs to be, as I said, it needs to be something on which both parties to the transaction are agreeable to.
Thank you.
If we use couriers, do we need to use Chief? We have never used this, but do we need? Sorry, but we have never used this. But do we need to get the online monthly statement of VAT for the VAT return?
Well, I think if you're using couriers, I think you're talking to someone like a fast parcel operator, that sort of circumstance. Then they will, again, it's the terms in which you engage their services, but they will be making the declarations on Chief themselves on your behalf. So you're engaging the courier, I would imagine, or the fast parcel operator, to bring the goods in on your behalf, and as part of that service, they will be selecting postponed VAT accounting for you. Again, assuming that those are those are the terms in which they operate. So I think in the first instance, it's just a case of looking at the precise service operated by your courier, fast parcel operator, and that should explain exactly how the VAT would be accounted for. And of course, if they are using postponed VAT accounting on your behalf, it will then appear on your PVA statement in the normal way as for any other import that you make.
Thank you.
Thanks. So this is a question regarding the interaction of PVA with MTD. For a VAT return period ending 31st March, the statement will not be available until April, at which point it will be posted as a journal into the company's accounting system. It then won't appear in the VAT report till April, but needs to be reported in the March return. How can this company resolve this?
I think this is more about how the company's accounting system works. I mean, the PVA statement covering March will be should be available, within the first sort of 10 days of April, and it covers the transactions for March. I mean, there's no way. There's no prescription on the way that traders or software developers who provide accounting software need to develop the software, but they need to do so that for March entries they are capturing the PVA statements, which covers the March entries. This will essentially be similar to the system that would have been used anyway for rest of the world to UK imports before the end of last year. It's essentially, that's the way the system will always have worked. The only difference being that instead of getting a C79 as you would have done for those imports, you're getting a postponed import VAT statement, and that will need to be reflected in the VAT return for the period to which it relates.
Thank you.
Next question: what to do if services/repairs/returns appear on your PVA statement? Import
VAT is only on goods, so services have nothing to do with goods. I may need a bit more information on what the precise nature of the question is here, but I mean the basic vision that services are different. You don't get import VAT on services. I think if you're talking about repairs, that sort of thing, return goods, again, this is going to be subject to customs rules. You might have reliefs, return goods relief. Your goods may be returned for repair. Again, you're dealing with customs rules here, and that will determine how how in the first instance the customs duty is accounted for, but also any changes to the amount of import VAT is due. So I think it's probably need to split this up into the different categories talking about, but look first at the customs rules.
Thank you.
It's a company saying that their supplier in Belgium insists on supplying their business in the UK under DDP terms. The supplier has told them not to worry about any customs declaration procedure as they'll deal with it. But any VAT incurred by the supplier at customs will be charged to us at 20% on the supplier's invoice. Is this correct and allowed?
Again, this is a consequence of the customs rules and the way that the import is being made. I think if we're talking about it may be the situation where effectively the person exporting the goods is in fact also the person who technically is importing the goods into the UK, and having done so, the goods are then being passed on to the trader. So effectively, what you could be getting, and it requires me to know the difference between the different customs ways of working. It's certainly legitimate for effectively the exporter to send to themselves as a UK VAT registered importer, and then for those goods to be sent on, as a secondary transaction onto the trader themselves. That may be what's going on here. It simply means that you're not actually the importer in those circumstances legally.
Okay, thank you very much for that. So thank you to HMRC for these presentations. I hope they were useful to everybody, and we'll make sure that we share all the slides with you after the event. If I can just quickly pass on to Mark Ellis from BDO, who's going to explain how to register and pay VAT in the EU member states. Thanks, Mark.